Credit cards are used to pay for items or services using credit. They are usually issued by stores, banks, or other financial institutions. They offer cashback, discounts, and reward miles. For those with little or bad credit, do not worry, as secured credit cards and debit cards may also be an option. Welcome to another episode of Financial Ventures. Today's video will discuss simple tips for paying off your credit card debt. They may not be new, but we often take advantage of them. If you like the content, subscribe to our channel and hit the notification bell for more informative videos. Everyone should be aware of their credit utilization ratio, or the amount of available credit a person uses. A high credit utilization ratio means they are close to maxing out their credit cards and often have a lower credit utilization ratio. They must understand how credit utilization works, as it is crucial to managing one's credit. There are multiple types of credit cards available. Credit cards attract customers with different offers and incentives like airline miles, hotel room rentals, gift certificates, cashback on purchases, and much more. These types of credit cards are usually called rewards credit cards. If an establishment wants to solidify customer loyalty, they also offer branded versions of their credit cards with the store's name on the face of the cards. This credit card offers perks like special discounts, promotional notices, or special sales. We also have secured credit cards, or a type of credit card that the cardholder needs to ensure a cash deposit first. This card helps cardholders be responsible for handling and using their card over time. These are the cards sought after by people with limited or poor credit histories. Lastly, we have a prepaid debit card, a payment card where the available balance matches the money that someone has already saved in a linked bank account. These cards offer higher lines of credit and lower interest rates compared to secured cards. One can secure a credit card, but it may take some building of credit history first. If you do not have any credit, banks may not extend their credit card offer to you as you are still an unproven borrower. You can start small by opening a secured credit card where you will all deposit, and the lenders or banks can see your habit of spending and repayment. Another way is when you establish yourself as the user of a particular bank credit account. Your history will appear, adding a longevity report to your credit. This effort is the start where the financial choices and good credit habits will pay off, as they usually reflect on a person's history. There are several strategies to pay off their credit card debt faster. It helps if one develops a plan first and sticks to it. They also should focus on paying off high interest rate cards with the smallest balances. And lastly, when you pay more than your monthly minimum, you will pay less in interest overall. According to the Federal Reserve Bank of New York, credit card balances were 7% higher in the second quarter of 2022 than in 2021. Yes, there may be inflation and rising interest rates, but these balances will continue to grow and become more expensive to pay off. So here are some tips on how to pay off your credit card debt faster. First is the avalanche method. J. Dennis Mancias, a financial advisor at Symmetry Financial Solutions, mentioned that these strategies suitable for saving money since it will make you pay the slightest interest at any given time. The avalanche method is when you list all your debts from highest to lowest interest rates, allocate minimal monthly repayment on each, and throw all your extra cash at the highest interest debt. Paying the most expensive balance is the cheapest way out of debt. A clear example is if you have $500 in hand. Make sure you pay most of the amount to the highest interest rate debt. Once fully paid, you maintain $500 and spend the next high interest debt you have until you pay off everything with the minimum budget you set per month. If you stick to this method, you will likely save more money. The second is the snowball method. Snowball is the opposite of the avalanche method. In snowball, you pay off your debts from smallest to largest. Getting all your debts paid off in the shortest possible time is an excellent motivation to keep on track and tabs on all your spending habits. This strategy is suitable for people motivated and powered by small successes in life. Be sure to be one. Third is the balance transfer card. An individual can have excellent credit despite debts only if they make their minimum monthly payments on time and keep their credit utilization ratio low. A balance transfer card is a zero-interest introductory offer that lasts around 12 to 21 months, and they will let you transfer your high-interest balances to the new card. This offer means you can save on interest for the entire 0% period, an easier and faster way of getting out of high-interest debt. This strategy will only work if you are good at keeping track of all your credit card payments, so be sure to be on top of everything before finalizing transfers. Fourth, make sure to keep your spending under control. What better way to keep track of your expenses other than making a reasonable budget and alleviating debt along the way? It is good to be in credit card debt if it has something to do with unexpected medical emergency expenses rather than chronic overspending or spending more than what you have in your account. Keeping track of your necessities such as rent, utilities, groceries, and gasoline is essential. You may also need to take care of your obligations like minimum payments on credit cards and other debts. Of course, having recreational expenses like eating out can also be good, but only at a moderate pace. Make sure to list all your expenses on paper, as this is a good strategy for people needing more budget. You can be out of debt if you know where your financial health is. Fifth is grow your emergency fund. You have to concentrate on building your savings before planning on taking out debts like credit cards. An example is saving at least $500 while ensuring you get all the minimum payments on your existing credit cards. This effort can make you tap up your savings and pay off your credit card, which can be a good source of funds when there is an unexpected expense. Sixth is understanding debt consolidation. Debt consolidation is a more effortless and less expensive way to pay off one's debt, but only if the interest rate of the debt consolidation loan is lower than the interest rates of the credit cards. If you pay your monthly dues on time, you can see a positive impact on your credit score. Always remember, you can save money if you try debt consolidation. Debt consolidation can be a good strategy for anyone with many credit cards, yet who need help to stay on top of their repayments. Credit card debt can be challenging, but as long as you're well aware of your actions and informed about your decisions, you can start paying it off. There are several ways to do so. It is just a matter of finding out which works best for you. Thank you so much for listening and learning with us. Please comment down your thoughts and suggest what you want us to discuss. We hope to see better with Financial Venture.